How to backtest put selling strategies. Have you ever wondered how to effectively backtest put selling strategies? This process is essential for evaluating how well your strategy could perform in real market conditions. Let's break it down step by step to help you understand how to do this effectively. First, you need to define your strategy parameters. Start by selecting the underlying stock or index you want to trade puts on. Next, choose the strike price in relation to the current stock price. This could be at the money or out of the money options. Then, determine the expiration dates for the options you plan to sell. You should also set your entry criteria, like selling puts when implied volatility exceeds a certain level. Finally, define your exit criteria, such as closing the position at a specific profit target or loss limit. Once your parameters are set, it's time to gather historical data. You will need historical option prices, including bid-ask spreads, for your chosen underlying stock and strikes. Aim for data covering a significant period, ideally 5 to 10 years. Make sure to include the underlying stock price data and volatility measures. Quality is key, so ensure your data has accurate timestamps and realistic pricing. Next, simulate trade execution based on your defined rules. Model your trade entries and exits while accounting for realistic execution prices. This includes considering slippage, which is the difference between expected and actual trade prices, as well as commissions and bid-ask spreads. For more accurate end-of-day valuations, use prices from about 14 minutes before the market closes. Now, calculate your performance metrics. Track profit and loss for each trade and cumulatively over the backtest period. Measure key statistics like average return per trade, win rate, and maximum drawdown. You can also evaluate risk-adjusted returns using metrics like the Sharpe ratio or Kalmar ratio to understand how much risk you are taking on for the returns you are getting. After analyzing your results, it's time to adjust your parameters. Review the overall profitability and risk profile of your put selling strategy. Identify any periods of underperformance to understand market conditions where your strategy may struggle. Adjust parameters like strike selection or expiration length to optimize performance. Be cautious of common pitfalls during this process. Avoid overfitting your strategy by testing multiple parameter sets. Make sure your results are consistent across different timeframes and market environments. Always include transaction costs and realistic slippage to avoid overly optimistic outcomes. Watch out for look-ahead bias and survivorship bias, which can skew your results. Finally, after backtesting, validate your strategy with forward testing. Use out-of-sample data or a simulated trading environment to confirm its robustness. Paper trading is a great way to simulate live execution and monitor performance before using actual capital. In practical terms, you can use specialized options backtesting tools or programming languages like Python. These tools allow you to customize your strategy parameters and execution rules while providing detailed statistical reporting. By backtesting your put-selling strategies, you can build confidence in your approach and make informed decisions for your options trading.